This is Siddharth Alwalia. Welcome to the 100x Entrepreneur Podcast. This episode is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Sripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category creating tech startups in fintech, SaaS, healthcare, and education, such as EasyTap, MyGate, and SignUp. To know more about Prime, visit primevp.in. Today we have with us Anand Chandrasekaran. Anand is the Executive Vice President of Product Management at Five9. He has 17 years of experience building successful products and leading product organizations. Most recently, he was director focused on the Messenger platform at Facebook, leading the growth of the platform to over 250,000 developers, including a customer care focus and 8 billion messages between businesses and consumers. He was previously Chief Product Officer at Snapdeal and Airtel. Welcome, Anand, to the podcast.
Hey, Siddharth, thank you for having me.
Anand, beyond a brief intro which I provided to our listeners, we would love to know more about your journey.
Yeah, happy to introduce myself a little bit more and my journey to Five9. So I've been at Five9 for about a year. And before that, as you mentioned, I was at Facebook. As you probably know, I was leading the Messenger for Business platform while I was there since inception and worked to grow the platform from about I think we were about a couple of 100 million messages between people and businesses when I started, and we grew that to about 8 billion messages between people and businesses. And so I actually knew Five9 as a partner in those days. I don't know if you know this, but like very much earlier in my career, I'd actually co-founded a enterprise software startup called Aeroprise straight out of Stanford. When I graduated, before that, I was living in India and I moved to go to Stanford for grad school, and have been in the States since. As you probably also know, I was in India for a few years in between 2014 and 2017, working at Airtel and Snapdeal. So that's sort of a little bit of my story. Having started, it almost feels like full circle, starting in sort of SaaS. And then coming all the way back to the SaaS world, but also I think there is an interesting trend going on, and Slack and Zoom, etc., are part of that trend where there is a increasing movement of a consumer DNA into SaaS products, where the cycles are becoming shorter. There's more iterative product development, more integration of kind of what AI can do into product development. So, kind of interesting timing for me to join Five9. So that's just a brief introduction of how I came to Five9 after my time at Facebook.
And why did you join Five9 from Facebook?
Yeah, so Five9 was actually a partner when I was at Facebook. And what I saw was there was this huge demand for interaction between people and businesses. And of all the use cases that we started working on, ranging from content to commerce to customer care, the customer care focus had the most traction, and we were able to grow the platform significantly on that basis. And so for me, there was sort of this clear opportunity where someone could build a SaaS model for delivering these tools to customers. And so it was kind of that perfect timing for me to go finish what I started in the Facebook journey as part of Five9.
And can you talk about the two acquisitions since you joined, Whendu and Virtual Observer?
Yeah, as you rightly mentioned, Siddharth, since I joined, let me just introduce the business a little bit. As I mentioned, we're a cloud SaaS platform that does customer care, right? So a lot of the other categories like sales or finance or HR have largely moved to the cloud. And customer care is really one of the final categories that is in the process of moving to the cloud. And Five9 is a public company, about 400 million or so ARR this year, where we build a SaaS platform that gets you up and running really quickly. We largely kind of take out companies that were previously using Cisco or Avaya gear and move them to Five9. And so we're still in these very very early days. if you remember, about a decade ago, we had this transformation in the consumer space from PC to mobile, and similarly, we're seeing this transformation from sort of on-prem software to cloud software. And as I mentioned, customer care is probably one of the final categories to kind of tip over and move to the cloud. So we have about 2,000 customers or so, and as they migrate, what we're seeing is a demand for products that are adjacent to this customer care space. So one company that we acquired is in the workforce management software space. It's called Virtual Observer. And so this is, if you're running a contact center platform, you also want to know how best to keep your workforce productive within the contact center. And so this is a market leading company that does that. So we acquired Virtual Observer in January. Going a little bit behind, Siddharth, we also acquired a no-code platform called Whendu. And this is allowing developers within our customers and within our partners to actually build really elegant integrations into 50 other systems and bring together sort of solutions for contact centers with 50 other systems. And so these are the two acquisitions that we've done. And one thing that you've probably heard is the SaaS industry is a high retention industry, right? So largely, you're successful as a company by having low churn and having high sort of LTV over CAC. And so that's sort of so five nines LTV over CAC is about six over a period of time. And so having these additional kind of adjacent products allows us to deliver a more complete solution to our customers, both large and small.
So Five9 is already at a $400 million ARR, as you mentioned, and it's on the path of being a Decacorn in the next few years. It's one of the 20 SaaS companies, or I would say only 20 SaaS companies have been in the history that have crossed the Decacorn milestone. How do you perceive it?
Yeah, so this has actually been an incredible year. The company has grown in terms of its market cap over 100%, and we've added about $3 billion to the market cap in the last year or so. And the company has been at a 30% odd enterprise growth for the last few years, and we intend. What we've said publicly is that we intend to have that growth for the foreseeable future. Um, and so that means we're essentially doubling every 3 years in terms of revenue. And so like I said, we are in very, very early innings of the space in terms of the percentage of this industry that has penetrated and moved to the cloud. It's about 10 to 15%. So there's still over 80-90% that is yet to move to the cloud. So kind of excited to be here. You know One thing that coming from the consumer world is there is a huge sort of element of cloud operations, and so cloud operations and reliability, that's a huge part of growing. And so that is an area that we're investing significant efforts, both in the past as well as going forward in the future. And as the number of customers grows, and as the kind of reliance on the solution grows, also the expectation of high reliability increases significantly. And so that's been an area where we've been focused on. And also, as I mentioned, the two acquisitions have helped us kind of expand out the total addressable market and provide a more complete solution to customers. And so, as I mentioned, we've added about $3 odd billion to the market cap last year. We're now around 6.5 billion or so. And so kind of excited about the trajectory forward, and being in kind of pretty elite company uh, with companies like Salesforce and Twilio and Adobe and so on and so forth.
So for listeners in India who are thinking a parallel, it would be a parallel to Freshworks.
Yeah, so that's a great example of a completely B2B focused company that has all its revenue coming from enterprises. Yes.
How has your India journey been, and why did you return for India for such a short period of time?
Yeah, so India was kind of incredible, and for me, there wasn't like huge plan to move at that point in time. I was at Yahoo. I had been there for about a little under 5 years, and I got to talk to the CEO of Bharti Airtel, Gopal Vittal, who fantastic leader. Got to work with Gopal pretty closely, and the charter was, if you see today what Reliance Jio is doing, Siddharth. So Airtel was had sort of seen the coming of Jio in a few years. And so in 2014 started to kind of preempt that and started to build out products, and bring someone on board who had probably never been at a telco but had built a lot of products. And so I was sort of having a fantastic time over there. Moved to India in 2014. We actually had our kid in India in 2014 as well. And It was sort of a prolific time that I had working with some incredible management team members over there. Um, I don't know if you've used Wink Music, which is a subscription music app. So my team led the development of Wink Music. We revamped the My Airtel commerce experience. We worked on Airtel Money, etc. And actually, I was having a pretty amazing time. And as you might imagine, when someone moves back from Silicon Valley and comes back to India, that's not an easy cultural transition, right? So we went through a lot of the uh, what could have been big challenges, and actually I was having a great time. And the opportunity to join Snapdeal sort of came out of the blue for me, right? So wasn't sort of looking to move, wasn't sort of looking to do something else. But the question for me was, finally in 2014, 2015, the internet was actually happening in India, and for me, it was a chance to either be a part of that journey or be on the sidelines, right? So I decided to sort of jump in and help build Snapdeal. And again, it was kind of this incredible journey that we had at Snapdeal at that time. When I was there, we not only built Snapdeal and the e-commerce side, but also Freecharge. And we did the acquisition. We sort of revamped the platform. We built a payments layer on top of it. In 2016, we relaunched it as a payments platform, a little bit ahead of its time, I would say. So today, if you look at what PhonePe is doing inside of Flipkart, definitely that model has proven to be true. But we were also a little bit early. We tried to do it in 2016, 2017, that time frame, a few years before sort of maybe we were adequately funded and so on. I was in, like you said, in India for about 3.5 years, and moved back to California when the opportunity to join Messenger and Facebook came along.
So coming on to your angel investing part, how many companies you have angel invested in till now?
Yeah, so I have been very lucky. So when I was in India, I got a chance to start doing this sort of on the side. And The way I sort of look back at that is, when I started in working in India, Siddharth. I don't know if you remember in 2014, there was no concept of a product head in an Indian technology company, right? There was the engineering team and there were business leaders, and there was really no well documented, well known product or design leadership in Indian startups. And so the time that I was there in India was sort of the start of that transition to have product leaders. And so, as you might imagine, a lot of founders who were starting companies, there were tech first, product first companies. They didn't have a lot of mentors around to help them build these companies, right? So I used to get a lot of unsolicited incoming request for help, basically saying, "Look, I'm intending to build a product first company, and I'd love to get some feedback on my product, or just kind of how should I think about succeeding in this space, some design inputs, etc." So that's really what I started doing. I started sort of rolling up my sleeves and helping founders in India, because my belief was, look, it was definitely the start of the internet really truly taking off in India. And I had moved to the valley in the early days of the internet around 99, and saw the ecosystem take off. And one of the things that really struck me about Silicon Valley, Siddharth, is that there is this kind of paid forward mentality, right? Like when I was starting out with Aeroprice, I would ping people out of the blue, and surprise, surprise, they would all respond back, right? And these are the most accomplished people in their world. And so I sort of saw an opportunity both to play a role in the growth of the ecosystem, but also truly to do my part in paying back or paying forward, as you will, and doing my part in return for all the people that helped me out. In particular, I had one professor at Stanford called Rajiv Motwani, who would sort of be very generous with his time and help early young entrepreneurs like us out. Um, so that became a role model for me when it came to sort of my giving back and my investing. And so that's how it started. Did a few deals in India while I was there, and have been doing a bunch of investments since then. At this point, there are about 50 investments, mostly I would say across the marketplace and fintech space, as well as now a number of SaaS companies, as well as practical applications of artificial intelligence. So kind of lucky to be in a few companies that are breaking out and starting to be successful, like Rupeek and Nobroker, Khatabook, GameZop, MoEngage, and so on and so forth.
So, can you talk about some of these companies where you were an early investor, and uh, at what valuation you invested, and what's the current valuation of these companies, and how they have grown, like Rupeek, No Broker, Khata Book,
Yeah,
GameStop, MoEngage you mentioned.
yeah. So I would say, in general, being an individual investor, I tend to be in the very early days, like the pre-seed round, or even earlier than that, and sometimes the seed rounds. And so Rupeek is actually a great example of sort of the thesis, where it's a very India first company. Um, and it was co-founded by Sumit Maniar and his team. And it's a great example of someone who is coming into a space that sounds like it's very crowded, but actually the consumer in the space is not being well served. And if you asked the consumers in the gold loan space in India, the NPS would probably be incredibly low. And it's also really fragmented, right? There isn't a single vendor who's used technology to scale effectively across the country. And so it's a great example of someone coming in from the outside, not having a lot of inside experience in the industry, but being a true sort of friend of the customer, right? And comes into a space where the NPS is super low for the consumer, and build a really strong consumer experience. And if you sort of use the Rupee product, every step of the way, the consumer stands to benefit from using the product. And also, it's a great example of the thesis I have, where it's usually really large markets. Like, for instance, the gold loan market, again, only 6% of India's gold is leveraged in some way, right? About over 95% is not leveraged. And meanwhile, folks don't realize they have a higher net worth to maybe start a company, or take a vacation, or get an MBA, or what have you. And so this is a great example of a fantastic entrepreneur who's building a great consumer experience, but also a large market. And so they've done very well since I participated in the seed round in 2016. I think most recently they raised a round from GGV Capital here in Silicon Valley, who's a firm that I'm very friendly with. And in the past, they've raised money from Sequoia and Excel and others in India. And that's been, one of the more successful investments for me. It's been really honored, lucky to have been in the company since 2016, and there I would say about a 90 to 100x return for the angel investors at this point. I think like that thesis I think applies to a lot of the other companies as well. No Broker is a C2C marketplace where buyers and sellers can talk to each other directly and avoid the kind of inefficiency that the middlemen bring to the process in India. Um, while I was in India, I've like looked for homes to rent two times. And Siddharth, you know what an inefficient process that can be. And so they use technology and artificial intelligence to connect the consumers, the buyer and the seller directly. And so that's another example of the marketplace model being used to bring a great consumer experience in a otherwise crowded market, right? Like housing tech market in India has been a pretty crowded market, but Nobroker has emerged as a breakout winner in the space. Same with Khatabook. They've emerged as a operating system for the merchant. As Geo brings a lot of people, new internet users into the ecosystem, there have been a lot of consumer successes, but they're also bringing a lot of merchants online. Khata Book is sort of the first app that a merchant would download and use for business purposes. And as the prices of connectivity are coming down, a lot of merchants are able to keep a reliable connection on and use apps like Khata Book for their business. And similarly, especially in a period of COVID and a lot of e-commerce apps being unusable because they're not doing deliveries. GameStop is tying up with a lot of these companies to actually allow consumers to play games and introduce a new revenue stream as their existing revenue streams all but die down. So a lot of these marketplace companies and fintech companies have been the core, but also, as I mentioned, MoEngage is a great example of consumer companies are driving SaaS demand, because all these consumer brands that are growing like crazy have the same need, but they don't have either the bandwidth or the priority to focus on the solution. And so enter, a company like MoEngage that builds this as a central SaaS platform and sells it to all of them, and grows on the back of consumers' app success. Siddharth, the other thing that I'm kind of excited about is a lot of these companies like MoEngage, like Lucidius, where I was the first seed investor as well. They are having their ambitions grow past the Indian subcontinent. So they have really good success initially in India, and they get a lot of traction initially. But then, like you mentioned, Freshworks. So Freshworks has got its ambitions way outside the Indian subcontinent, and similarly, a lot of companies are moving to the US and growing as global software companies. Being based in California, I sort of am able to spend some time while they're here as well.
And how do you find these companies and the founders?
Yeah, so most of the new companies that come my way, I mean, obviously, as you can tell, I'm not on the ground, and most of it is coming from just really good word of mouth in helping the current companies, as well as through referrals from existing founders that I worked with.
And can you talk about the you have 5 exits till now from your angel portfolio, right? And Find and Innovate being the notable ones. Find got exited to Reliance Geo, Innovate got exited to Oyo Rooms. How big were the exits for you personally, and
Yeah,
what
so
learnings were there?
Yeah, as you might guess, Siddharth, the stage at which I tend to come in and work with founders, it tends to be super early, and at the very very early stages, it's usually a founder bet. So obviously a bet on the market as well, but largely you're betting on the founders and the early team. Find and Innovate were absolutely founder bets. The team Harsh and Farooq, and the team at Find is absolutely one of the most incredible founding teams that I've ever met, and lucky to have worked with them and seen their journey. One of the things that really struck me about the Find team was, despite the fact that they were in a very difficult space, e-commerce is a very low margin, hard to break through kind of space. But despite that, they were so focused on being generous with their knowledge, and that's been a big part of one of the reasons I do these podcasts is sort of giving back and sharing knowledge with other folks, right? The ecosystem grows when people give back, people share knowledge. And the Find team is a huge role model to the Indian startup community in terms of how generous they were in sharing code, sharing knowledge, sharing best practices, etc. I absolutely feel like they sold early. They were absolutely on a very interesting company, but they couldn't have become a part of a bigger ambitious company. They are now part of Reliance's e-commerce platform, and so couldn't be more happy for them. And for I think it was like around like a 50-60 million dollar exit, and so all the investors did pretty well. And similarly, Innov8 is run by Ritesh, who's fantastic founder and also now seed investor, giving back to the community, and did a great job sort of bringing a space for small companies. In India, it's hard as a small company startup to find a space that feels like a place that you belong. And Ritesh created this fantastic space in very central locations in Bangalore and Delhi and so on as a co-working space. And is now part of another really ambitious company, Oyo Rooms. And so for both of these entrepreneurs, I couldn't be more happy that they are in a extremely entrepreneurial environment, whether it's Reliance or Oyo. So both of those were good exits, and I do think that both of them sold early, but couldn't be more happy for them. The one thing I'll say is that uh, this is again, like, if you're long on a market like India, you have to call out the things that could be better so that they can be improved. The amount of paperwork that we have to do an acquisition is just insane. And so, literally we were like doing the acquisition, and it was like about 3 or 4 months of paperwork before the acquisitions close. So I think there's definitely probably a startup opportunity for someone to come in and make the paperwork and the process more efficient for corporate transactions.
And can you talk about, because we have talked about your success as an angel investor. Let's talk about your failures as an angel investor. Which are the companies that didn't do well?
Yeah, I would say there's been I don't think like one particular company comes to mind, but I've definitely had a few companies that have failed, and myself have had like several failures. And actually, like, I would look back and say even my experience at Snapdeal is mixed, right? Like, while we pioneered some incredible things, it was a difficult environment for the economy. I don't think the macro environment made it easy to navigate a complex company. We had raised a lot of money. It became really hard to kind of right size the company, and the company has taken drastic steps, reducing like 70-80% of people over a 12 to 18 month period before getting to a place where the company is now doing incredibly well. And so I would say that's one kind of failure. The other kind of failure is honestly, until these companies succeed, and now some of them are breaking out. But sometimes, when you hear these success stories, it feels like they were successful all along. But having been on a lot of these journeys myself, as well as following the journeys of these founders, it's rarely a straight line, right? Like, it sounds like sometimes it's an overnight success that's been years in the making, right? So it takes like for instance, some of these companies that are breaking out now in 2019, 2020, like, we went through 16, 17, 18, 19, sometimes being incredibly patient and working hard through challenges. I think largely I would say, um, the failures that happened are, I would put them in two categories. So what one is, companies that grew too fast and had like complex cost structures and started burning money before they truly had product market fit, right? So that's, I think, the biggest feedback I would give is, like, if you're starting a company, take the time to just ensure that you get to product market fit before scaling and bringing on a lot of people, and starting to increase the burn and stuff like that, right? And especially when capital is easy to get, sometimes it's easy to look past some of those challenges. And I think, like, ironically, now we're in an environment where it's actually a great time to build companies that offer true solutions to real problems, right? So that's probably the first lesson I would call out, is just do make sure that there is product market fit before scaling. And then the second is, I would say, just like team chemistry, right? Like, I've seen founding teams where um, either it was a solo founder, but like, looking back, I would say maybe this founder should have gotten another co-founder, because they didn't have all of the skills to start the company, and having someone who's a great partner in crime would have been fantastic. And the flip side, right? Like sometimes two or three founders did get together, but they were not the right chemistry with each other. They hadn't sort of talked about the journey ahead of time, and so they had very different views of what the journey would look like, and it kind of didn't work out from a founding team perspective. So those are probably the two big things that I've seen as recurring themes when I've seen companies fail. And obviously, when you are um, when you're an early stage investor, you expect a bunch of companies to fail. So that part is not a surprise. But when it happens, these are largely the two themes that I've seen to result in the failure.
Also, you've seen failures in the companies you invested because they're not able to raise capital, especially in during these times, because capital becomes scarce during downturn.
Yeah, it's interesting, Siddharth. So uh, I've not found a lot of examples where truly the company was doing well and deserved to raise capital and couldn't raise capital, right? Like it largely could be traced to like either the cost structures or sort of getting ahead of where they are as a company, and so on. But I think that you are right that even if you are a company that's doing well, we are in like incredibly unprecedented times, right? Like you've had probably guests on your podcast talk about what a unprecedented time it is. I think on every level, right? Whether it is the healthcare crisis that we have, and the need for founders to take care of the team and the customers and just employee safety, to sort of economic reality, right? Like I don't think a lot of companies are able to just operate as going concerns, given that people are in many countries are sheltered in place, right? And used to be that, especially if you are a global company, and I'm not talking about very tiny startups, I'm talking about somewhat scale companies, you would say, look, like one part of my customer base is not doing well from an economic perspective because there's a macroeconomic problem in that part of the world, but maybe another part of the world is doing well. But this is an unprecedented time where all the countries in the world and all the parts of the world are actually going through this kind of what we call pandemic, right? And so there's really kind of a yeah, once in a lifetime kind of occurrence, and there's a lot of things where we don't have a precedent for it. One thing I'd like to call out is at 5 9, we actually did something that I'm incredibly proud of, which is we actually gave a sum of money to all the employees in the company below director level, for whom that sum of money would make a huge difference. When so we did, like, no layoffs or reductions in force, but we also kind of took this additional step to take care of our employees, and it's driven huge amount of kind of positive response from employees. So I would say from a founder perspective, this is a incredibly challenging time. And so while I haven't seen this in sort of past patterns, I do think that this is a unprecedented time, and there's a lot that we will learn about kind of managing through a complex crisis as a result of the past couple of months.
So the common lessons, which other investors have shared on the podcast have been uh, for COVID-19, and it's been, I think, fourth or fifth month where the economy has been continuously tanking. Uh, the lessons are, cut cost at all levels, conserve runway at least for 24 months, be very frugal in your spends, and uh, look for uh, survival first. Uh,
Yes.
any other personal lessons that you have observed or learned in the last 2 3 months of
Yeah,
COVID?
I completely agree with all of that. I think one experience that I've had is that I think any crisis like this, it's not like it changes people, right? It actually reveals people. And I've found that crisis is a great time where people sort of true personality comes out, right? It sort of reveals character, reveals personality traits, as opposed to changes people or changes character. And so I've actually been kind of incredibly impressed and kind of inspired by the level of resilience that I'm seeing out there. I think that people have absolutely been it's a blow to the system, right? Like both their personal well-being, their family well-being, their company's well-being. But by the same token, the level of resilience that I've had a chance to see, everything from simple things like how resilient kids have been, despite the fact that their schools are closed and their patterns have been interrupted, and they're now home the entire day. They can't go play with their friends, and the resilience that they're demonstrating through this, all the way to companies demonstrating resilience. The two examples that I would call out that I've been very impressed by and kind of inspired by are one, I really love how Airbnb has been navigating the crisis. This has been kind of really bad for them, as you can tell. The level of business that's declined for their product, but the way they've navigated this crisis is has been kind of incredible, and the principles that they've followed through it. And then the other story, which is probably less known, is a US company called Panera Bread. So I've been following the story. The CEO is a CEO of Indian origin called Niren Chowdhury, and Niren has been talking about Panera Bread's incredible way they've navigated this crisis, and they've opened up completely new product offerings of delivering fresh grocery. Because if you sort of follow their business, they have a lot of fresh ingredients in their business, and rather than selling it just as cooked items, they now sell bread and milk and fresh produce and so on to customers, and that business has been doing very well. And they launched this entire new business in maybe like a couple of weeks. And so, whether it's Panera Bread, which is a very kind of old school business, if you will, that has been digitized and transformed digitally, or an Airbnb like business, which is digital, it's a native internet business. I think several companies have been inspiring in sort of managing this. And one thing that I was very taken by, which Niren talked about in the Panera Bread story, is this concept of building windmills, not bunkers. So one thing that obviously you need to conserve cash, you need to sort of get into survival mode, but also you don't want to like go in a bunker and hide out until everything clears, right? You want to sort of build windmills that actually start leveraging what is going on in the crisis and start to kind of turn the business around to add value, whether it's supporting people. So many factories have turned around and started making PPE, personal protective equipment, and so on. So I think like this whole idea of building windmills rather than bunkers has been one of the most inspiring things that I've got a chance to read and take away during this time.
That's fantastic. That's very unique approach during times of crisis to build something which is truly leveraging and adding value rather than just hiding out and wait for crisis to get over.
Right.
You have the good fortune of working with Marissa Mayer at Yahoo, Mark Zuckerberg and Sheryl Sandberg at Facebook, and Sunil and Gopal Bharti. Uh, so, what have been the common things you have learned?
Yeah, Siddharth, as you mentioned, like in the last 10 to 12 years, I've been kind of lucky to work with some well known leaders fairly closely, whether it's Marissa at Yahoo, leaders like Mark and Sheryl, and so many incredible folks at Facebook, Gopal, as I mentioned, and Sunil Mittal at Bharti. And most recently, I work for an incredible leader, Rowan Trollope, who led a big turnaround at Cisco when he was there over a 6-year period. So I would probably look back on a few lessons. With Marissa, the big thing that I learned was this notion of happy people make happy paintings, which is if your employees are in a good place and they're happy, then they are going to deliver work that delights consumers, right? So kind of this direct connection between like kind of the morale and the health of the team impacts the health of the product, right? So she had this quote that she used to use. I also kind of really liked her product review process, sort of this formality around rigorously reviewing products every 6 weeks or so, having a cadence, having a plan of record for everyone to follow, and also knowing where you have a top down plan of record and where you have an experimentation approach. This is something that she brought from her days at Google. So learn that from my time at Yahoo working with Marissa. I think with Mark and Sheryl, it's really this. One thing that everyone has known is Facebook is truly the pioneer of growth hacking and a culture of growth, right? Like product driven growth as opposed to purely acquiring users through marketing and spending money, right? I'm not going to touch on that because there's like so much documentation around that, and Facebook is truly a pioneer in that. But the one thing I'll touch on is this notion, two things actually. One is this notion of when you are in a difficult crisis, as Facebook was in 2016, you actually get out of it by building, right? And so Facebook really continued to build its way out of a crisis rather than becoming stagnant and stopping building, especially for a company at that size, right? Greater than 500 billion valuation. And The other thing is, I learned a lot about kind of how you determine values for a company, right? Facebook got into almost a little bit of trouble for the moving fast and breaking things value that the company had, right? And one thing that I learned was how values have to be trade-offs, right? So if you have a value like, oh, you got to be honest and you shouldn't cheat people or something like that, everyone will agree with that, right? There is no other side of that that is equally likely to be true, but you're picking one side over the other, and it's truly a trade-off, right? Um, so by saying you want to move fast, what you're saying is that there is another side where you move slowly, and there is pros and cons of both, and you as a company stand for moving fast, right? And that does come with its benefits and its pros and cons. And so your values have to be true trade-offs, right? It can't be just trivialities. And that's probably one of the big things that came up again and again during my time at Facebook. I would say with Gopal, the thing that I learned was that he was truly one of the best leaders I had seen, who could go from being incredibly long-term oriented and incredibly strategic, like doing war games to like prep for the arrival of Reliance Geo 2 years from now, to actually going to one region and talking to consumers in that region and tying together that region's growth plan to those users and figuring out if the plan was going to fly or not, right? So just going from incredibly strategic to incredibly tactical, and then going back to something incredibly strategic, like protecting the brand over the next 10 years or something like that. And that, I've usually seen leaders be good at one or the other, and Gopal was a great example of someone who could quickly multitask and go from one to the other. Um, I think with through a lot of these companies, the one other thing that I learned, and I'll probably share this for a lot of the folks listening. One thing that I've been doing for the last 3 or 4 years is literally the first thing every Monday that I do is to send out my top three priorities to my team, and I've been doing that for the last 3 or 4 years very regularly. And the number of times that I've avoided major miscommunications, misalignments just by doing that simple thing on Mondays, I've lost track, right? And so that's probably one thing that I learned a few years ago from the leaders that I worked with, that I think would be very simple, very small, but goes a long way in aligning teams. Is that what are you doing this Monday to this Friday? And it's only three, right? So it shares the top three. And so by doing that, and imagine everybody shares the top three that they're working on. Um, it really aligns everyone and creates a sense of transparency, that everybody knows what everybody else is working on, regardless of their seniority. And then the other piece is there is sort of this immediacy to things, right? If you're distracted, you know what is a distraction versus what is critically important for you to get done in 5-day work week or a 7-day week, 7-day period. And so I probably shared that as something I learned a few years ago. That's a great way to get teams to be incredibly productive.
And can you talk about your product principles and about building great products that you have learned working with these leaders, especially which the principles which would be valid during these times?
Yeah, I mean, I would say, like I said, the biggest thing that an entrepreneur can fool themselves. This is true of even larger companies when they get into new products or new features. Is truly like, are they creating value, right? And are they solving a problem that is here and now and is critical, and people would pay money for, right? And ironically, a bad economy or a crisis is a great time because it's a great equalizer, right? Like it really sort of gets rid of a lot of the fluff that people probably were willing to engage with in the past, and it really brings it down to the essentials, right? And the tools that people continue to pay for during a crisis are probably the best tools to survive through the crisis, because they are truly adding value, and sometimes they even grow during a crisis because companies double down on those tools or those products. um, I think one thing that we're all seeing is truly how critical it is to stay in touch during these times. And the number one app in the world is a partner of Five9, Zoom, which is seen over 200 million daily participants and reaching 300 million daily participants. And we work really closely with both Zoom as well as Microsoft Teams, two companies that have been very, very successful, two products that have been very successful during this time. And that's actually a very interesting area where I think increasingly some things that are one time behaviors right now are likely to become more longer term behaviors, right? So the number one thing I would say from a product principles perspective is kind of constantly figure out by talking to customers if what you're building is critically important, right? Like a must have versus nice to have. And how elegantly are you solving that problem, right? Again, like sticking with a Zoom metaphor, because it's really the company of the moment. um, it's not like Zoom was the first company to solve this problem, but the way they did it, it simply worked, right? You click on the URL, you open up a meeting, and it just simply works. And so sometimes, even though the problem statement may have existed, just providing elegant solutions to the problem is a huge differentiator, right? Like just working every single time can be a differentiator, especially during a time like this. So that's probably like one kind of evergreen product principle. The other thing I would say is, I think it's critically important that product leaders, product managers, especially during this time, are able to exhibit judgment, right? Like what I mean by that is they're able to sort of listen to business conversations, business problems, challenges that are out there that is like being expressed as a pain point or as a business challenge, and translate that into what the computer science problem is, right? And what is a differentiated solution. And that, I think, is becoming an increasing skill to build great products. And also, one thing that I've found to be super critical is there are times in the product cycle and there are times in a company life cycle where speed is a differentiator, right? Like if you have like like Zoom went through some huge security blowbacks, and they just responded incredibly fast, which is, I'm sure, fresh on so many people's minds. And they've largely made those problems go away because they responded so fast. And so there are times when speed is critically important, and there are times when if you want to go really far, you want to go as a team, right? So alignment is super important. And so again, like one other principle is, when do you orient towards speed and when do you orient towards sort of deep alignment? And sort of this notion that I talk about with a lot of the founders that I connect with, as well as my own team, is making decisions when you have 70% conviction, right? Which is Keith Rabois' principle. And a lot of times, there's teams that are looking for additional data and struggling to make decisions because they're looking for that 80%, 90%, 95% conviction. And essentially, if you are making decisions based on 70% conviction time after time after time, you're going to be one of the more successful companies, because that is a pretty high batting average to be right 70% of the time over a long period of time. And then last but not least, I would probably say, once you've found a huge problem that is worthy of your life's work and worthy of solutioning, and you have provided an elegant solution, then it's okay to add a little bit of your own craftsmanship, if you want to call it that, or a personality, or a differentiator that is sort of your own twist to the product, right? Um, Whether it's irreverent language or kind of humor or whatever you want to call it. So those are probably the three things. Like, find a huge problem statement that's a pain point for your consumers or your business users. Come up with an elegant solution, and then once you've done one and two, you earn the right to introduce a twist or a personality of your own.
Thank you for sharing, these timeless product principles. And concluding the podcast with some learnings from your, being an angel investor. So there are many folks in the ecosystem who have been there, done that, and now want to give back as an angel investor. So what's your advice uh, on building a portfolio, and like you have built right now a portfolio of 50 plus companies, five of six of them around to be unicorns, and around 50 to 100x exit, because it has to be sustainable. It cannot be done without an expectation of a return, which doesn't build a cycle to invest in new companies.
Yeah. So, I'll again give you my top three. I guess it's the curse of being a product manager, is that you always like talk in threes. And so I'll give you three top takeaways now I've been lucky to have done this for 5, 6 odd years. The number one thing I would say is, um just keep in mind that you are not the hero of the story, right? The hero of the story is the founder, and you are just lucky to play a role in their journey. And largely, like, if that is your first principle, is that you are here to support the hero of the journey, which is the entrepreneur, right? And throughout, like, there are founders now that I've known for 5 plus years, sometimes even more than 5 years, and I've supported them over a long period of time. And sometimes I, supported them without even being on the cap table or involved in any way formally. And so I would say the number one principle I've learned is, just being founder friendly is a differentiator, right? And I'm not saying founder friendly just as a checkbox, right? I mean, like, truly, how deeply can you take it? Um, and there have been some times where founders have like crashed in my place because they are coming to visit California, and they decided last minute to extend the trip or something, and they couldn't get a hotel room or something like that. So truly, like, how friendly are you to the founder, and how much are you willing to support their success and their journey? And this is especially true as the company scales, right? Like, especially as the company scales, the investors, the board members, etc. There are not a lot of people that the founder can just call and just bounce something off, right? Especially if it's a difficult situation. And so, being one of those people that founders just like to talk to and like to call is something that I think is super important for me. The second thing I would say is I think that, as they say, you make your money with your successes, but you make your reputation with the failures, right? So honestly, I would say the question I would ask is, if you went through an experience where the founder didn't do well, would that founder work with you again, and would you work with that founder again? And hopefully, you are there for them even during their bad times, right? So that's really where you make a reputation as like someone founders can rely on. And you'd asked earlier, like, how I get most of my deal flow. Most of it is through positive word of mouth, and founders saying, hey, x founder told me that they've had a great experience working with you, that kind of thing. And then the other thing I would say is that, truly, like, yeah, I know this is like a cliched thing, that this is truly long term, but it's true. Like, none of the decisions that you make today, you're going to know if you're right or wrong in any reasonable short term time frame, right? Like, you're going to know if you're right or wrong. Maybe 3 years, you have a sense of it, but truly it's going to be 5 years plus that if it's going to be incredibly successful. Like, I'm starting to see maybe half a dozen, maybe 10 companies from the 2016, 2017 vintage now start to break out. And, it's clear they're going to be incredibly successful. But it takes a while to figure that out, right? So I would say just being in for the long term and like committing to give to the founder over this long term is probably like the other thing. And then the true third thing I would say is that if you're an angel investor, you have to understand the power law, and you have to understand compounding, right? So I've heard a lot of angel investors who are patient for 2, 3, 4 years and then like exit soon as the company breaks out, right? And I would say this is probably one of the worst things you can do for yourself. And if you sort of look at the power law, like you're going to make most of your returns from the small number of companies that break out, and so exiting those at that time is probably not a great service that you can do for yourself. And so just kind of from a portfolio management perspective, like spending the time holding on to the companies that are doing really well, right? That's probably, especially as an individual investor, the temptation to take the returns off the table is pretty high. But again, being truly aligned for the long term means that you sort of believe in power law and compounding. So those are probably the top three, I would share.
But how do you know when to exit? I'll share with you an example. One of the angel investors in Giphy, Giphy, uh,
Yeah,
which was acquired recently for $400 million, called out on Twitter that he only is receiving 5x exit, whereas according to when he entered and today the valuation is 30x. And why is that? Because uh, the 400 million the Facebook is offering is most of being taken by the late stage VCs. So are angel investors getting screwed because when the exit happens, the large chunk is first given to the VCs? So is it better to exit before when a VC is offering you at a, let's say, 30x 40x valuation, or is it good to wait till the final acquisition happens? Because most of the companies, as we know, in India especially, wouldn't go for IPO. They would be
right.
an M&A, which you saw with Find and Innovate in your portfolio, or
Yeah.
they would be a secondary buyout by a large VC for 75 100 million dollars.
Yeah. No, I think that's a good point, Siddharth, and I would say you're right. I mean, there's a lot of sort of horror stories over the years, etc. But I would say, look, if you are looking for a smaller sort of 1x, 2x, 3x kind of return, there's actually tons of public market opportunities that deliver those kinds of returns today, right? Like as I mentioned, like the SaaS space that Five9 is in. There are so many companies that have grown 3 to 5x in the last 12 to 18 months, right? So it's possible to get that kind of return even from the public markets without a lot of risk. I think when you're getting into early stage companies, the risk reward equation is a little bit different, right? Like yeah, early on, it used to be this 10x plus return being sort of the be all end all, and now people look for sort of unicorn like exits. So what it's called changes based on the timing, but people are looking for bigger exits, right? And that's where the compounding and the power law comes into play. And so you're right. What you're saying is sort of the exception that proves the rule. But in general, like when you're managing your portfolios, it's going to be clear that like 80-90% of your returns are going to come from less than 10% of your portfolio, right? Like it's just like clearly the case. It's not going to be equally distributed. And so managing how you sort of get the yield out of the companies that do really well, while not also potentially inconveniencing the founder in doing so. It's definitely an art rather than a science, right? But you're right. Like if you can, if you sort of feel like the company may not be, an incredibly large successful company, then taking an exit, especially if it's an organic exit for the entire company, those are obviously smart things to do. And those singles and doubles sort of keep you going en route to sort of the huge winners, right? Which, as you know, like in India over the last 5 to 10 years, there have been probably 20 to 30 companies that have hit $1 billion valuation. And globally, there is like just around 300 to 350 companies. I don't know what the number is with the last few weeks. Probably it's a smaller number, but like there's not a lot of companies that have that kind of exit, right? So we're not talking about a lot of examples where you have that level of exit. And so if there is opportunities along the way, absolutely worth
So
considering
how
them
would you do it
as
personally?
well.
Like say for example, many of your companies have crossed 200, 300 valuation mark. So would you wait
Yeah.
wait a very long time, or would you seek whenever the next Series E or F round is happening?
Yeah, I think it's a definitely a case by case, Siddharth. But one thing I would say is, for me, it's absolutely, do I still believe in the story, right? Like if I were coming into the company now, would I be buying or selling, right? If I feel like, hey, this is a fragmented market, and this company is at the most going to get, let's say 10% market share, 15% market share, and they're almost there already, and there isn't a whole lot of upside, then you're not leaving a lot of upside on the table. Whereas I feel like in some cases, they could be like 300, 400, $500 million valuation, but this could be easily let's say a $5 billion company. You're actually leaving like a 10x multiple if you exit at a $500 million valuation, or even lesser, right? So I think it's definitely different from company to company, and I think it's also different for the kind of investor you are, right? Like if you are, there are a lot of individual funds versus an individual angel versus a early stage firm. And so it's also like, what economics are critical for that particular investor. In my case, I sort of go back to being incredibly long on India, long on entrepreneurs. And so, as a principle, like I try to keep my life simple, not do a lot of portfolio construction thinking, and really reserve a lot of the time in helping founders and in finding other great founders to work with. So, to keep my own life simple, like I spend far less time than probably some others on this kind of portfolio construction.
And do you also see VCs forcing out early angels to consolidate their ownership?
I think that there definitely is a lot more opportunities now, especially in really successful companies that are breaking out in competitive spaces. But I don't think it's. I think there's always the opportunity to choose whether you want to be a part of the exit or not. And particularly, Siddharth, it comes down to, is there a mutual belief that you are a positive force for the company and you are helping the founder, right? I think ultimately what every new investor asks is, who's going to help this founder the most, and are they aligned and incentivized to help this company be successful? And so if you're seen as like a very early investor who still continues to help the founder, who still continues to be positive, who still continues to make introductions, who still continues to help hire great executives into the company. I mean, those are the big challenges that every company faces at different stages. And so, if someone's a positive force and is seen as helpful in those areas, then there is a tendency to want to continue to keep them. I think if the investor is sort of seen as not believing in the story, and maybe making it a little bit difficult for the company to execute, then there is maybe a bit more pressure to, maybe give that investor an exit, because that's probably what they were looking for anyway.
Thank you so much, Anand. It's been wonderful to have you on the podcast. And thank you so much for sharing your learnings and experiences.
Yeah, thank you so much, Siddharth. A great pleasure for me to be on. Hope you are staying safe and staying healthy, and hope everyone listening is staying safe and staying healthy as well.